Hey everyone, thanks for joining us. This is Maple's August Community AMA. I'm going to take the first 10 minutes to talk to you about July's numbers and what we've shipped. And then Gleb's going to put some of the questions that we got from the audience to me in the back half. And then we've got 8 to 10 of them queued up. These cover everything from rates, competition, product, the token, financials, risk, and where institutional adoption is heading. So with that, let's dive in. Quick skim through the agenda. So look back, financials, and then community Q&A. So let's take a look at the numbers. July in numbers was pretty good. We had overall around 4.3 billion in AUM. So this was up 42% year on year. So nice headline growth over the year. And one of the big numbers to call out here for us was, of course, Maple's 6.4 billion in originations. So it's worth noting, in the first half of this year, we effectively did more than we did in all of 2025. So this was huge growth year on year. And it's also worth pointing out, if you were to only look at one of the metrics from the first half of this year or year to date, the one that I would point to is the revenue year to date of 12.2 million. So significant growth year on year relative to the smaller AUM growth. So what it's showing is that for every new dollar that we get on board, we're actually doing much more with that in terms of generating revenue and being efficient with it. You can see here as well that Maple's revenue, which of course for us comes from net interest margin, which is the difference between what we lend money out at and what we pay to LPs and depositors in our pools. So that net interest margin of 80 bips shows that we were able to grow revenue year on year without taking significantly more risk or without paying for growth by trimming back our revenues. And you can see this as well in the performance of Syrup USD. So the yield has outperformed the peers on chain by over 130 basis points. Now, this additional yield is not from taking more risk. It's coming from the niche of institutional underwriting that Maple is so well positioned in and where we've really staked out a dominant position. But let's continue and look at some of the highlights from July on the product and milestone side. So a couple of things really jump out. One of the big ones for us was Robinhood Earn. So this was the first time that institutional on-chain credit has sat inside a mainstream consumer app. Somebody opens Robinhood, they select Earn, and then when they deposit their USD, they're instantly earning yield, a large portion of which is underwritten by Maple's on-chain lending. So really, I think what this signifies to a lot of people is this is finally bridging on-chain credit and on-chain activity with traditional fintechs and neobanks. And we think this is going to be a huge source of growth for us for the rest of the year. The other key thing to call out, we of course had the Kraken warehouse, which we called out in our Q2 call, but it's worth noting again that what we're doing here is this is one of the first times the on-chain warehouse has provided a facility for an exchange's OTC lending business, all backed by BTC and ETH. But the important call out here is that now that we've built this the first time, this becomes a product that we can roll out for any other exchange or fintech partner who's looking for these kind of sophisticated structured facilities. So we think that having got the first one done, this becomes a very replicable business line for us. And then of course we would be remiss if we didn't call out Syrup USDG. So this was the first new product that we rolled out in 2 years on the stablecoin lending side. And already it's grown to over 230 mil within a month and a bit of launch. And that was from a standing start, so the product didn't exist before July. So this tells you that stablecoin yield continues to be underserved in the market and that this is a repeatable wrapper, which we can roll out for other stablecoins that are coming to market. And we expect that this is going to be a huge tailwind over the coming 12 and 24 months and beyond. But let's look at one of the reasons that a lot of you are here. So taking a spin through financials and token utility. So to begin with, let's take a look at the balance sheet and the Syrup Strategic Fund. So the balance sheet, the Syrup Strategic Fund for Maple currently holds around 78 million Syrup tokens, which you can see on the slide here, as well as 4 million in stables. And this has been built up from money or from funds provided and generated by our ongoing revenues. But that doesn't tell the full story. So Maple's full balance sheet is, of course, 110 million syrup tokens, as well as 14.5 in stables and liquid assets, which provides a buffer for strategic opportunities or for a rainy day, and provides plenty of reserves to get us through a bear market. But what I want to take a moment to point out is that in July, true to MIP 21, we sent 136K of revenue towards buybacks in line with the 10% threshold. And so we purchased 850,000 syrup tokens in July, and this brings our year-to-date buybacks to 3.35 million, as you can see here on this slide. Now, we're comfortable today with the balance sheet position that Maple has, partly because we spent the first half of the year building stablecoin reserves in anticipation of the kind of bear market that persists today, and to ensure that Maple has everything it needs to survive through to the next bull market, and that we would never, as Joe and I explained on the Q2 community call, be in a position where we have to sell assets at a bad price to keep the lights on. So we feel very comfortable with the position that Maple's balance sheet is in today. But let's take a deeper look at MIP 21, which of course passed after the Q2 community call in July. So this defines how Maple's revenues and value gets back to token holders. So below 1.5 million, as you can see here, we would be doing 10% towards buybacks. This is what took place in July. Between 1.5 million and 2 million, we'd be doing 20%. And then above 2 million in monthly revenue, we would be doing 30%. But I want to point out that the key thing here is not necessarily the percentages themselves. It's that we replace the discretion here with key triggers that are transparent for the community of token holders. You no longer have to trust our judgment on when and how much to buy. You can simply look at the rule set that we have here. And as you can see that as revenue grows, the buybacks in turn grow. But this cuts both ways. So it gives us as well the flexibility that in months where revenue is smaller, so below 1.5 million, we're not needing to spend as much on buybacks, and this allows us to maintain healthy reserves. And then when revenues grow and we're in a stronger position, we can in turn spend more on these buybacks. Because it's worth pointing out that overall, the Syrup Strategic Fund is about more than just buybacks. It's to give us the flexibility to pursue strategic opportunities that help grow Maple, as well as to provide liquidity in the market and reserves for buybacks. And really what MIP 21 is about providing a rule that governs this third use case, which is the buybacks. And that brings us to the end of the formal programming, but what we wanted to do was spend ample time on community Q&A. So we've taken in questions from the community, and Gleb is going to help bring those up now, and then we'll run through them. But this will cover everything from markets, product, rates, competition, how we handle liquidations, and where we see the future going from here. Gleb, I'll pass it over to you.
Indeed. Thank you for the update, Sid. So let's kick off the Q&A part. First question is on the markets. With the Fed now openly debating a hike rather than a cut, how does Maple perform in that scenario?
You know, it's funny. We kind of began the year with everybody anticipating, you know, when a rate cut would happen, and now we've kind of flipped to everybody predicting that we might actually get a rate hike in September. Now, the good thing about Maple's position is that the vast majority of our loans are on short duration. So we have the ability to kind of reprice these with 30 days or less notice for the most part. And that means that if the Fed were to hike rates, we do have the ability to reprice the book higher and then in turn pass on higher rates to our depositors. The other thing I'd point out is that from a kind of crypto market specifically, talking about the crypto market specifically, what we tend to see is that when rates are hiked and risk assets trade off, folks start to think about more and more, how do I get a good yield on my stable coins? And so we actually would expect that in that environment, we would probably see more inflows. We might see more inflows through products like Robinhood Earn, some of the other integrations that are coming, and just directly into the syrup products, as people get very hungry for yield when they don't expect that risk on assets are going to trade up. So I think it benefits us, and in turn we'll be able to pass on those higher rates to our users.
Thank you. Next question has to do with competition. SyrupUSD is running about 130 basis points above comparable products. What exactly is the source of that spread? Why can't the competitor simply copy it, and does it compress as more capital comes on chain?
Yeah, I'll deal with that in both parts. So I think that the key thing here is that the spread is driven by originating and underwriting specialization done by Maple. So we source loans directly from institutional borrowers. We have to go through an underwriting process with each one, sign legal documentation with them, set up custody arrangements for them, and then service and handle the loans in case something goes wrong. So that work comes with a price. That's why we've been able to charge higher prices to borrowers, and why this can't simply be copied by a permissionless marketplace. Peers in the market, those who are doing permissionless marketplaces, everything gets set by the algorithm. So based off a utilization curve. So there's no credit officer, there's no borrower relationships, there's no legal structuring, there's no recourse in case something goes wrong with the loan and the collateral. That's a legitimate design choice, but it makes it harder for them to price the kind of premium that we do. And in Maple's case, that premium gets passed on in the form of higher yield to our users. Our borrowers are happy to pay a little bit extra to have their collateral safely stored in a qualified custodian instead of placing it in a smart contract. And they like the fact that they can store native Bitcoin instead of having to wrap it. They also get certainty on rates. They get a white glove service when it comes to margin call. Now, longer term, could this compress? Sure, eventually. I think spreads compress in every credit market as it matures. We've seen that time and time again. But our answer in that case isn't going to be just to try and defend the spreads. It's twofold. So Maple is going to have to focus on growing our loan book and scaling, because a slightly tighter spread on a much larger lending business is still a great business. And also we're going to move up the structure. We've already done the Kraken warehouse. So we're going to look at more structured facilities like that command higher spreads, as well as RWA assets. So we've talked in the past around fintech, asset-backed lending, prime financing. So we still have plenty of areas that we can grow into, and this will help us stay ahead of competition there.
Thank you, Sid. Indeed, plenty of important differences there. Next up, we've got a question on Maple's latest product. SyrupUSD went from launch to 229 million in months, and it's the first Syrup asset in 2 years. What does the roadmap look like from here? New assets, chains, collateral types, and what's the single biggest constraint on shipping faster?
So I think, the way I read SyrupUSDG's growth number, it's got over 229 mil in TVL from new users since July. Tells us two things. One, stablecoin yield was and continues to be an underserved market. You can tell that by all of the fintechs and neobanks looking to launch these products. They really need a way to keep users who have stablecoins on their platform. So, initially they launched crypto trading, then their users wind up with stablecoins, then they need a way to keep them on the platform. And so I think that continues to be underserved. We see a ton of these products coming to market over the next 6 months. But for us, what are the three directions from here? So we're going to have more assets. You saw we launched SyrupUSDG. This was our first new stablecoin product in 2 years, but there's no reason we can't extend that wrapper and that franchise to other new, stablecoins that come to market. The other thing's more venues. So we've seen, Robinhood Chain has done tremendously well. It was over 750 million within a month of launch. But we have Arc, Tempo, Inc. Maple's products are really compatible on any chain, and we don't want the users to have to come to us. We want to go to where the users are. So, our products have the ability to go cross-chain. We've seen that done successfully with our launches here on Robinhood Chain, but also in the past with Solana, with Plasma. So we're very confident that we can successfully penetrate other venues, and then we'll see more integration. So I've already mentioned. We've already cited the success of the Robinhood Earn program, but Maple Embed, which we talked about in our Q2 call, is something we want to roll out to fintechs and neobanks everywhere. We would love for more consumer apps to make this available to their users. And we see that the key for the growth of these products is to get new people into DeFi. DeFi hadn't had new money coming in for the last couple of years, and these fintechs and neobanking apps are an exciting way to bring these products to users. And then the other thing is that I shouldn't neglect to mention is, of course, the structure. So for us, the other area on the roadmap is going to be structured facilities, fintech, asset-backed loans. We're mindful that the Bitcoin-backed lending market is around 30 billion today. We would love for that to continue to grow, but we don't want to be constrained. We want to continue to evolve and go beyond that market, though it is our specialization. And we see that Maple could lend to fintechs and provide other asset-backed lending facilities, which allow us to command higher rates. It's less correlated with crypto, and brings us into competition with some of those, some of the traditional private credit players.
Thank you, Sid. Next question is a great follow-up to the one you've just covered. It has to do with fintech platform distribution as well. And it's as follows. Your yield products are becoming embedded inside somebody else's app, Robinhood Earn being the clearest example. Why do platforms like that choose Maple over building it themselves? And where do you see fintech Earn programs going from here?
It's probably a good follow-on for the last question, because we were just discussing or kind of touching on that topic. But why do they choose us rather than building it themselves? So I think it's because a lot of these platforms, their focus has been slick user experience, fantastic distribution, but they haven't had to build a credit engine. So that's what we want to plug in and be. We want to be the credit engine that powers these products. So building an underwriting business takes multiple years. We've been doing, Maple first started in 2019. We've been doing the over-collateralized lending since 2023. But it takes time to build a credit team, build the borrower relationships in the network, do the legal structuring, do the custody arrangements, set up margin call alerts. All of this is it's very complex stuff. And most consumer apps don't have any interest in actually owning that part of the business. What they want to do is focus on growth, distribution, and bolting on other products. So I see us as complementary rather than competitive for a lot of these neobanks and fintechs. They bring the users, we bring the credit and the yield for them. Where's it going to go over time? So I think fintech Earn programs are going to be one of the largest growth channels available to Maple over the next 12 months. And we're very early. We've only just done this one with Robinhood Earn. There will be others coming. But every fintech and neobank is now asking themselves the question, how do I keep the users who have stablecoins on my platform? And how do I stop my users from going to my competitors? Almost none of them want to become an underwriter in order to keep that business. And the yield has got to come from somewhere real. It's got to come from somewhere sustainable. And that, in this case, means lending businesses money and ensuring that they pay it back. That's the gap that Maple has carved out. And so there's a lot more conversations like this happening over the next year. And it's worth noting they've picked up significantly versus where they were last year. And I think the other point worth noting is these relationships are pretty sticky. So when one of these players decides to incorporate Maple and have part of their Earn product powered by Maple's loan book, replacing us involves redoing due diligence, redoing legal structuring, reporting, risk committee sign-off. These are careful and methodical processes. And so it's a high barrier to entry once these products are set up to bring other new people into it. So, at the end of the day, our goal is not to displace any of these brands. We want to be a great partner. We want to be the credit engine powering these yield programs and these stablecoin Earn programs.
Thank you, Sid. Indeed, lots of growth opportunities for us and our fintech partners. Next question covers the SERP token. MIP21 replaced discretionary buybacks with a revenue-linked rule. What was the logic behind moving to a rule, and how should holders think about the token's economics evolving from here?
Ultimately, I think there were two reasons, and they kind of trend in different directions on purpose. So for holders, what we wanted to do was provide predictability. Under discretion, you had to trust our timing. You didn't know how much was going to be bought. You had to check our revenue and then to know what follows. Under our new rule, you just have to check our revenue to know what follows. And because the rate steps up at increments of 10, 20, 30%, every incremental dollar of new revenue that we get converts into buybacks at an increasing rate. Put another way, the revenue begins working harder for you the more that we make. For the company, what we wanted to balance here, and that balance is important to strike, is balance sheet flexibility. So the rule scales with revenue. So if we have a leaner month, we're not committed to spending a fixed amount on buybacks, and we protect the reserves. The failure mode we wanted to design against, which impacts so many startups in the space, is that you keep buying through a weak stretch, and then you have to sell assets or tokens near the bottom to continue funding operations. We've been through, this is the at least the second bear market we've been through, and so for us, survival is the most important thing, so that we have the opportunity to grow. On the evolving from here part, this program is going to run for 6 months. Governance will review it at the end. I think it's natural for tokenomics to keep evolving. We try and be thoughtful and listen to the feedback from the community. But the answer here is that the single biggest driver of value accrual is ultimately going to be revenue, because revenue here, we've allowed revenue to convert into buybacks. But ultimately, the thing that's most important for long-term success here is revenue and growing the customer relationships that we have.
Indeed. And the point on revenue is a nice link to the next question that has to do with financials. As the loan book grows from here, how much does your cost base have to grow with it? What would it take operationally to run a book twice the size of today's?
That's a good question. This is the important part of running on chain. So the answer is it's much less than people would expect. So Maple could easily double the loan book from here without significantly increasing the headcount or anything close to a doubling. So the reason here is structural. Maple's cost base scales with the number of deals and counterparties we service, not necessarily the dollars inside of it. So it's much easier for us to take a $200 million deal, double it to a $400 million deal without having to add additional headcount to do that. But doing that doubles our revenue. So you can see that we have significant operating leverage built into the business. And as our revenue scales, because the cost base doesn't grow by much, all of that drops to the bottom line. So incremental growth from here is very powerful for ultimately the net income earned by the protocol. But to give people a little bit of color on the size of the operation here, we have 4.3 billion assets under management. We have close to 2 billion in deposits and loans, but we're about 45 people full time on this. So personnel is the dominant line. We of course have to be mindful of spending adequately on security, infrastructure audits, legal compliance, and marketing. But the key point here is that most of this is actually fixed against the size of the loan book. So any incremental growth coming from Robinhood Earn, the other fintech Earn programs that we're talking about, ultimately drops to the bottom line, and that's that links back to value accrual in the form of our buybacks here. And that matters for holders really because of that MIP21. So operating leverage means every incremental dollar reaches the bottom line, and the buyback rate steps up as that revenue grows.
Indeed. Next up, we got a question on risk management. How many liquidations has Maple had this year, and what happens operationally when a loan gets close to the line?
So it's something people ask about all the time. And I think it's really worth pointing out the difference here between us, other DeFi protocols, and retail lending businesses. So this year, to date, we've had 2 partial liquidations. And these are both on smaller loans in the realm of $1 to $2 million versus our larger institutional loans, which can run anywhere up to, the largest one we've ever done was $500 million just before Christmas. But the thing to point out is, because we lend to institutions, what happens is that when we issue a margin call, typically our borrowers, and this doesn't matter if it's Friday at 1 p.m. in the afternoon or 2 a.m. on a Sunday, our borrowers are typically posting additional collateral within 2 to 3 hours. That's what the institutional borrower base gets us. These are firms with treasury operations and a trading desk who's staffed around the clock. So there's always someone there to answer the margin call at 3 a.m. And they have a lending relationship that's long-term that they want to protect. They don't want to lose their access to capital or borrowing. Whereas in a retail pool, there's nobody to call. So retail businesses will usually be liquidating their borrowers during volatile periods. And that's the entire reason why Maple's liquidation history looks the way it does, with only a handful stretching right back to, to late 2023. Operationally, how does this look? So our loans are over collateralized from day one. We monitor them continuously. We have automated alerts. But what happens is that as coverage deteriorates, we issue an automated margin call with a cure period. If it's not cured, the borrower has an event of default declared. We send notice to the custodian. We take control of the collateral in the tri-party account, and then we proceed to liquidate. So every single one of those steps has been tested multiple times.
Thank you, Sid. That was very comprehensive. And to wrap the Q&A part up, got a final question, which is on institutional adoption. Stablecoin regulation has landed. Tokenization is a stated priority at the largest asset managers, and traditional credit funds are starting to look at on-chain lending. Does that institutional wave make Maple stronger, or do you end up competing with balance sheets 100 times your size?
Yeah, it's a question we get a lot, particularly now that there's Genius. Obviously, Clarity has hit some hiccups, but people are saying, well, if one of these private credit shops comes in and they have 100 billion in assets under management, where does that leave you guys? What if one of these large banks comes in? What I'd say is that it actually makes us stronger. So even though the balance sheet point is a fair one to raise, a lot of people get these things backwards. So the constraint in this market hasn't really been borrower demand. It's always been institutional. There's always been institutional demand to borrow against crypto. The scarcity was the capital willing to be lent to them. So more capital arriving into the space can ultimately help us if we can be a great partner for the new wave of institutional capital coming in. That's the area that we've been short of historically. And this is a competitive dynamic. I come from a banking background. Those big bank balance sheets are tough to move. The credit committee, the capital treatment, the operational risk frameworks, these guys are not set up to handle stable coins, tokenized assets as collateral, and collateral that trades 24/7 and can and has a higher degree of volatility. And it's not a criticism of these institutions. It's just the reality of how they operate. But what it means is that when they come in, they're very often looking to come in through structures or through partners who are experts and specialists in this space. And this is where Maple aims to shine. So we have we have years of experience lending stablecoins. We've built our own proprietary tech stack to do stablecoin loans, collateral management, and we're very familiar with how to liquidate tokenized collateral. So we think of ourselves as a great partner for these institutions coming in, and we have the specialized expertise that they lack, and they have a balance sheet that we could work with. You can already see that now this year with the entry of large players like Robinhood, but also in the Kraken facility that we did. These kind of structured facilities are exactly the type of thing that institutional investors and traditional allocators love, and that's the type of thing that we would hope to be able to roll out to insurance funds or insurance companies, pension funds, and endowments that want to come in the space and begin earning yield on chain in time. So the firms that won the market institutionalized, when the market institutionalized, were never the ones necessarily that had the biggest balance sheet. They're the ones who built the capability and the tech stack that everybody else needed to use. That's how I think about it.
Thank you. Yeah, that's very clear. And this concludes the Q&A part. Over to you, Sid.
Thanks, Gleb. All right, time to wrap up. So I think three things I'd love everyone to leave with. One, Maple's machine works and is currently compounding. We've seen the revenue growth year on year, over 130%. We've seen the asset growth. What we need is just more assets to feed into it. And that's where the second part comes in. So second thing is Maple's becoming the credit engine inside other people's distributions. So Robinhood, Kraken, Syrup, USDG. We see tremendous amounts of growth coming from these fintech and neobank integrations. And it's bringing new users in, and that feeds more capital into the credit engine that we've built. And three, that the buybacks of the token now happen by rule, not by discretion. So you can watch our revenue and see and determine what happens with buybacks based on MIP21. And then for forward looking from here, so the next AMA is going to be on September 16th. Would love for everyone to join us for it. And of course, the quarterly call with Joe and I will be on October 13th, running through Q3 results. So in the meantime, keep the questions coming. The ones we took today were fantastic. And thanks everyone for tuning in.